Welcome back to Making Sense of Retirement. I'm John Jagay, joined again by Vince Oldray from CFG Retirement. Vince, always good to be with you.
Same with you, Jack.
So we're talking about bond alternatives today. I know historically, when the market goes down, bonds go up, and sometimes the market goes up, bonds go down, and we've got a pretty good market right now. So bonds may not be as sexy or attractive as they have been in previous times. So what are your thoughts on bond alternatives and what we can do and why we can do it?
I think the first thing is to make sure we understand why bonds aren't really that attractive anymore. Mm-hmm. And that's because if you think about bonds over the last 40 years, the interest rates of bonds have gone down and just kept going down. And in fact, like 40 years ago, bonds were at their peak as far as interest rates go. And we used the bonds as a control of volatility, tried to reduce our volatility compared to our market exposure. So that tend to work, except for bonds have come down so low, or the interest rates have come down so low. Now they're really not worth the risk that we're taking with the bonds, because bonds are almost as volatile as the stock market, and we're not getting a lot of return for that risk that we're taking. So we do need to look at some alternatives. And I think it's huge to understand that when we think about our traditional investing, a lot of times people think of stocks and bonds. We might want to start looking at, or I think we should start looking at, some alternatives. So I actually have a list of alternatives. You know, some are rather boring, and then some are kind of exciting. They're different. We'll go through each one. But the first one that's, rather boring, everyone's like, well, I already know that, I can do that, which is a CD. And, the benefit of a CD is we know what the fixed interest is going to be, and we know what the term is going to be. And it's actually typically not a very long-term lock-in, but they're still very safe, and we still know what our return is going to be. But I would argue that bonds have kind of come to a point where they're almost giving the same interest rate as a CD at this point.
Wow. Yeah.
And so that's where we look at a bond, we're like, well, they're pretty volatile right now. If we looked at last year, bonds went down 15, 20%. It's not really worth the return that we're getting. And if you look at like the Barclays Bond Index and things like that, they haven't returned a very good, over the last 5 years, there hasn't been a great return. I think it's somewhere around 2 to 3% total. And so if you look at your overall portfolio, if you're wondering, well, the market's up a lot, why isn't my portfolio up a lot at the same time? It's usually because, or the culprit is, the bonds. So you could look at CDs, right? And then CDs would be helpful as far as when it comes down to reducing that volatility. But then, as you said earlier, that's not very attractive.
Right.
So, as we've aged here, we tend to not look so attractive or not become as attractive, right? I think the same thing's happening with bonds. Bonds are kind of aging out.
I was wondering where you were going with that analogy. Okay.
Bonds are aging out, and they're just not as attractive, and so are CDs. I understand that. So the next place we could kind of go if we want to get a little bit more attraction or a little bit better rate, you can look at something called a fixed annuity. And I know a lot of people don't like annuities, so not a big deal. Annuities tend to have, there's different types of annuities. Right. But there is something called a multi-year guaranteed annuity where it's just a straight fixed rate, no bells and whistles, no fees. It's just like a CD, just a little bit longer term. It's with an insurance company. They give somewhere between 2 to 3%. Sometimes they have what they call fire sales, where they offer a very attractive rate for a certain period of time for you to jump in. And sometimes are, again, around 2 to 3%. So that's a little bit more attractive, right?
Yep.
But again, I'm not too excited about that because you're kind of giving up time. So I do have a couple other better ones here for you.
Let's hear them.
But it gets a little bit more complex, okay?
That's the trade-off, okay.
That's the trade-off. So there's something called notes or structured notes, okay? Mm-hmm. And before you get into anything, you got to make sure you're researching whatever you're about to buy. But there are something called structured notes, or in our case, we call them flash notes because they're only 1 year term. And they're actually a product with a big bank. And they give somewhere between 8 to 10% fixed interest, which is pretty good.
Now you get my attention.
Yeah. There's a caveat, though, okay? So anytime there's something that good, you got to say, well, okay, well, what's the catch?
Right.
The catch is if the market drops more than 30%, you still get the interest, but now that note becomes participating with the market. So if you put $10,000 in and the market drops 30%, then your $10,000 becomes $7,000 and it's going up and down with the market with like the S&P 500, for example.
Ah, okay.
But you still get the 8% or 10% interest all on the way, okay? And that interest gets paid out monthly. So it's still a great alternative vehicle, but there's a little bit of risk. And so the way that you try to avoid that potential risk is you actually do like a ladder. Like we've heard of bond ladders or CD ladders. You actually do a ladder. So you buy one every month. So if you have $100,000, then you would break them out and buy one every month because then your trigger point would be different each month. So for example, we had some notes available in February. The fixed interest on it was around like 13%, really, really good.
Yeah.
And the market then was actually a lot lower than it is now. So if you think about where it is now, the market would have to drop like 45% just to trigger this note. And so the good news is if the market doesn't drop 30% at all, if it, by the end of the term, if it doesn't drop 30%, they just give you your money back. Okay. So the downfall to that is then we have to find a new note once the note comes due. So it's really not like, that risky in a way. I mean, there's still some risk because it's based on the bank and it's a publicly traded security. So with our clients, it's at TD Ameritrade, Fidelity, and Schwab is where they're being held. So the funny thing is these things have been around for a long time. The difference is that was in the past, you were able to buy them through the wirehouses, which typically you and I didn't have like a lot of access to.
Yeah.
Because you have to have like a lot of money. And that's because they were rather expensive vehicles in the past. You would pay a big commission for a vehicle like this, and it would bring down that interest rate. Then it didn't make sense to do. Well, when it became something a little bit more available, and not just only through the wirehouses, they pretty much put that commission back into the product, which is giving it such a good interest rate.
I see. Okay.
So great alternative there. Before you jump into something like that, you could. If you type in structured notes, it's going to come up with a lot of different things. Just like if you type in annuity or stocks, I mean, it's going to come up with a lot of different things.
This is where you have to talk to a professional, Vince, because as we know, just because it's on the internet doesn't mean it's true.
Well, and there's a lot of different types of structured notes. So you can do a structured note with like a real estate investment company. We don't know when that money is going to come back. They're not backed, by always the best money. Whereas when we use a note like this, they're backed by big banks like PIMCO, or like Barclays, UBS, Goldman Sachs, JP Morgan. All those companies have something like this. And what we do anyway is we kind of find out each month, we look at them, see who's going to have the best offering, and that's the one that we use. So we will use this for a portion of our clients' money or as a bond alternative. We don't use it for the entire portfolio. You don't want to do that. You want to be very careful with what you're doing because there is still a little bit of risk. And what we like to do is actually ladder them out. And it's a great play also for income because that interest comes monthly. So it's a great alternative.
Got it. What's next on your list?
So one of the other ones, if you don't want to venture that way as far as like a note, you could venture into the way of something called a hedged equity portfolio. And what we're using are options. So a lot of people might have heard of options. Maybe you're scared of them. You don't need to be scared of them. And that's because we've heard of options with GameStop and that kind of thing.
Yeah, those meme stocks for sure. You want to make sure that you understand what you're doing or you're working with somebody who understands what they're doing when it comes to this stuff.
When we're doing like a hedged equity play, what we're really doing is we're buying the stock and then we're buying an option below that stock as a way to get out without getting majorly hurt.
Okay.
So it's basically, I don't want to call it an insurance policy, but it's kind of like having something to cover our butt if the market tanks.
Got it.
I don't want to call it an insurance policy, but that's kind of what it's like. It's we have a bit of a deductible. That's why you have like that option that it's this payment price that we're willing to pay for the stock if it drops to a certain amount, and then just get out. But the good news is with a mutual fund or an equity play like this, if you're doing it right, you should be diversified, spread it out. We use some different funds that will do that for us, and that way you can spread out that risk, but it also will also keep you whole. So, during like the pandemic, it didn't go down a lot because they're buying options 5% below what you bought the stock at. That's not a big difference between, buying something for $10. If it only goes down, 5%, that's not that much.
Right.
Comparatively to, so it might be going down to $9.50 or something like that. That's not a lot in comparison to what the market actually did, which was go down like 30, 35%.
I see. Okay, that makes sense.
It's just another way of kind of covering our butt, which is the whole point of what bonds are. The whole reason why we buy bonds is to help reduce our volatility of our stock or our equity portfolio. It doesn't really work anymore, or it hasn't been recently. So let's find an alternative, and that's where an option play comes in. Now, I get that this stuff is a bit more difficult. It's kind of a lot of financial jargon. It's not meant to get too confusing.
Yeah.
But what has made it easier for us to use something like this is because a lot of these brokerages or a lot of these broker houses like Schwab and TD and Fidelity have reduced their overall costs for us to do something like this. Mm-hmm. It was much, much harder to do this in the past because options cost a lot. There's a premium and stuff to buy a lot of this stuff. But as technology has advanced, it's reduced a lot of those costs. And so we're able to kind of do that a lot easier now without having major fees to go along with it. So you can do this at a very reasonable price, just like a regular mutual fund. And that's kind of what's really exciting about finding some of this stuff and being able to rely on it in a way of a 60-40 stock bond mix like it was, like you've been using or maybe have had in the past.
Yeah, and I think you make a really good point there, Vince, about the technology making things easier. And I think it's important to adapt with the times, both in terms of technology and in terms of how the market has changed, particularly over the last 18 months and the ups and downs we've had since the beginning of COVID. If you were having this conversation with me 25 years ago, we'd probably be on an AM radio station on a Saturday morning. But it's 2021, and we're doing it on a podcast. You've got to adapt with the times and work with somebody that is on top of all this stuff so you can be best positioned for your financial future. Vince, if someone wants to come talk to you at CFG Retirement Group, what are the best ways to find you?
Best way is actually give me a phone call, 952-657-7470. Ask for Vince or Mike. And I know we haven't talked about Mike before a whole lot, but he'll be on our podcast going forward. But again, call us at 952-657-7470 or email me at vince@cfgretirement.com. And again, we won't really talk about this stuff right away when you do call us. I mean, yeah, sure, you can call me and we'll talk about some of the stuff. But what I want you to do if you do call is put your stuff together first and understand what kind of mix you have.
Yeah.
How much stocks and bonds do you have? And that will kind of segue into our next podcast where we'll talk about whether or not 60-40 stock bond mix really makes sense for you to use anymore and how much risk you might be taking with a 60-40 mix. But put that stuff together first. Give us a call, and then we'll say, okay, here's how you might be able to reposition things. Instead of it just being, hey, I want to buy that product. No, we don't want you to buy products. We want you to create a financial plan that works, a portfolio that works for your financial plan. So give me a call at 952-657-7470, or you can email me at vince@cfgretirement.com.
It is important to know that no two financial situations are identical, and it is important to know what's going to be right for you specifically. Vince, always a pleasure. We'll talk again soon.
Thanks, Jack.
Investment advisory services offered through Assured Retirement Financial Group, Inc., a registered investment advisor in the state of Minnesota. Insurance products and services are offered through CFG Retirement Group, Inc.